I'm Darius McDermott from FundCalibre, and today I'm joined by Eva Sun-Wai, who's Deputy Manager on the elite-rated M&G Global Macro Bond. Good afternoon to you.
Good afternoon, how are you?
We're fine, thank you. So we've got the challenge of demything or explaining fixed income and what particularly has gone on in the fixed income markets this year. So bonds have generally had a difficult start to 2021 and have fallen in value. Are you able to give us a bit of an explanation as to why that has been?
Of course, yeah. It's an interesting situation this year, as we know the key risks to economic growth, but I guess we have little idea of the timescale, and so bonds have fallen as markets are trying to price in what these different economic risks are. Initially, the catalyst to this sell-off was the end of last year when we had the Biden election. So we had the eventual outcome of a blue sweep materialize, and we also had the announcement of vaccinations coming to market, and those coincided at very similar times. And so both of these things have caused a lot of recovery in risk assets. So equities in particular have performed very, very well. Those are negatively correlated to bonds, where bonds are seen as safer assets, tend to perform better in worse times, which is what we saw mid-pandemic last year. So we've basically seen a bit of a reversal of those trends. We've also had the situation where these growth prospects will correlate with reflationary forces in the market, so prompting a recovery of inflation, whereby we've had years and years of record low inflation due to globalization, due to technological improvements, aging populations, etc. And all of these forces generally have driven prices lower as markets have become more and more competitive. So now we've had a big shock to the market in terms of a pandemic. This has forced some of those trends to come to a halt, as is the case in terms of, as we've seen, we've had supply chains disrupted, we've had demand being disrupted. So you're getting a lot more factors that are pushing inflation forward and inflation expectations upwards, which is what drives a lot of bond markets. We've also seen big fiscal packages, for example, coming into market, whereby in the middle of the pandemic, we were seeing more monetary support. So that was good for bonds because it means that central banks were lowering their rates, were coming out with quantitative easing, etc. And so that was very good for bonds. But now priority has shifted to fiscal through, stimulus checks, etc. That has also been detrimental to bond markets as they're expecting less central bank support in that way.
So you touched on inflation there, and I think that's a real key thing, not just for bonds, but for many other risk assets. Do you think it's we're having just an inflation expectation, or do you expect there to be real inflation and then the historic relationship between higher inflation and eventually higher interest rates from central banks? Do you think that's the path over the next 1 or 2 years, or is this just a bit of inflation euphoria coming out of pandemic with vaccines and stimulus, as you've described?
I think they're both very important. Inflation expectations is what drives markets. So when you look at real yields, that is nominal yields minus inflation expectations. It's not minus realized inflation. And so what the market thinks is going to happen is what will affect the bonds, as opposed to what does happen naturally. When the underlying prints materialize, that can adjust the expectations. But at the moment, we're in a situation where we're in a very transitory year. And I think we'll see central banks continue to say this and continue to say that the underlying prints are too noisy, there's too much going on. And so the expectations are still for those reflationary forces to materialize. But as I said, in general, bond markets build inflation expectations into their pricing models. And so returns can be compromised by inflation eroding the value of those bonds in terms of the principal and the coupon payments. And so it's not really surprising that markets are worried about this cost of inflation, especially when you think about governments have borrowed excessive amounts to try and fund, furlough payments, that fiscal stimulus. And so as inflation continues to rise, those bonds potentially become more, especially as you said, if interest rates rise. And so there's a big level of stress, I'd say, from central banks, where they don't want to see that big increase in refinancing costs because of inflation.
So then that leads me to my key question. With the outlook uncertain for inflation and interest rates, should investors still put money into bonds today?
I think there are definitely areas of fixed income markets that offer value. I think, for one, a very large player in the market is inflation-linked bonds. And so you can access direct exposure to inflation through products like inflation-linked bonds, whereby the coupons are directly linked to CPI, RPI, etc.
So
across different markets.
If there is inflation, that income would naturally go up with that inflation. So you're getting some inflation protection.
Exactly. Yeah. Exactly. Yes. So the value of the bond would increase as the yield comes down, for one, because of demand or the decrease in demand from the nominal government bond, which is the more general government bond. And you also get that increase in value from the inflation element that is naturally built into the bond. And so you get that in both government bonds. You can get inflation-linked government bonds. You can also get inflation-linked corporate bonds. And so there are lots of areas of the market that can generate exposure to an inflationary market. And so there's definitely areas there that we think are attractive. In the same way, now that we've seen government bonds sell off so much, there's an element of where is fair value, and do we now think that they are cheap enough to start buying back? So if you believe that now actually government bonds look cheap, for example, versus corporate bonds, or even versus equities or other asset classes, I think there are elements of value there.
Eva, thank you very much. I think it's always a difficult subject to cover, fixed income, and there's an awful lot going on with central banks on both fiscal and monetary sides, which do, of course, affect bonds. So thank you very much for your time. If you would like any further information on the M&G Global Macro Bond Fund, please visit FundCalibre.com.